What kind of boots are those?
Thursday boots.
Oh,
Thursday boots.
So I went hiking with Jen this last weekend. We went up to Lake Blanche. It was like 7.5 mile hike in the snow. Pretty cold, right? I was wearing my trail runners, and I told you can hike in trail runners if you have spikes. You don't want to hike in trail runners when it's cold because, man, my feet were just frozen.
Yeah.
But since then, I've been kind of on the lookout for like boots. It's funny because I was telling Jen, I'm like, I need some boots, need something new to keep my feet warm. And she's like, why don't you ask Jesse? He always looks really nice. I was like, oh, I like it. Okay. And oddly enough, you're wearing very nice boots.
these are like a walking boot, if that's the thing.
Yeah.
Definitely not a hiking boot.
Well, if they keep my feet warmer than my trail runners did,
you get different problems. You probably end up with a bunch of blisters with these boots.
He's just trying to fill his toes. It's been a week. No, I'm just kidding.
As long as they're warm blisters, I'm cool with it. Did you guys do anything fun this weekend?
I feel like time with the kids just all kind of blends together.
Yeah, we just hung out and got some food. Oh, we went to, I love Mr. Shovu.
Oh, yeah. I still haven't tried that place.
Oh, I love it.
This is the Korean place, yeah?
But this is the hot pot.
Yeah.
Yeah.
It's Korean hot pot. Like a buffet. You go and you cook your seafood and stuff and meat
in the
table.
hot pot.
Yeah.
Not the barbecue though.
Oh.
Different.
My bad.
I went to one of those too. Happy Lamb Pot is what it's called.
By Yummies?
I don't know.
Is it Orem? Or by you?
No, it's Midvale. Happy Lamb Pot's in Midvale. I was actually eating there and I was like, I got to tell Jesse about this because I know you really like food. Mm-hmm. It's like the experience is crazy. I think it's the same thing though.
Yeah.
Do you have like a cauldron, right? And they bring out a broth. And then you put the meats in and your seafood and whatever.
So good.
Yeah.
You need so much of it and you still feel light afterwards. And I love that.
Yeah. It's a great thing about seafood. Yeah, for sure.
So there's a spice. It's a peppercorn. I didn't know what it was till the last time we went. But I had a peppercorn. I ate the whole thing. I didn't know it was a seasoning. And it like unleashed something in my mouth that I had never experienced before. The only way I can describe it is like a Christmas waterfall. I'm not even kidding. So next time you're there, or go to the Happy Lamb Pot.
Wait, is Christmas supposed to denote like a feeling, or is it a flavor?
So like kind of both. We'll lean on the flavor side. It was kind of like a chai. Oh. Like kind of like a chai flavor.
Yeah.
But also feeling because it's really cold.
Okay.
Like a chai, super cold, and then like waterfall, like my mouth was like gushing Christmas waterfall. It was so intense. I made Jen try it, and she's like, "Oh my gosh, I need water! I need water now!"
Was that hot?
It was like kind of spicy to her, but it's not spicy. It was really intense. I didn't know it was a peppercorn. I thought it was like a secret, spice from Asia, but it's peppercorn.
Oh, you know what was cool? I don't know how it was at yours, but like they have on the wall all different forms of ramen, like in the packages from all the different Asian countries.
Oh, that's cool.
So we tried this cheddar noodle spice one, and like the couple next to us was like, "Hey, just put in half of that pack, like the spice that they provide." And so put all the cheddar in, but just do half of the spice. I'm like, all right. We did that, and it was still hot to me.
Yeah.
It was still hot. Like I was sweating, and there's only half the pack of heat. Like if we put the whole thing in there, I would have been literally. If I ever have like my nose like stuff, like it's all stuffy, and I'm gonna go over there and do the whole pack, and I guarantee it'll
gone.
Yeah.
An instant decongestant.
Yes. So, anyways.
All right. Well, from instant decongestants to cheddar noodles, and hiking in the winter, and Thursday boots. We are here today at the HIG Podcast. Guys, this is episode 17.
Wow.
It's made it to episode 17. Here in Provo, Utah, at the Harris Financial Center, with a special guest. Welcome again to the show, Jesse. What's up, Jesse?
Great to be back. Thanks
this
for having me.
is number 3?
I think so.
Yeah. Round 3. Jesse, welcome to the show. I'm MattyP, and I'm here with your host of the HIG Podcast, Bronson Kaufusi.
Hey, everybody.
What's up, Bronson?
Not much. Excited to be here with Jesse.
I know. It's a good time with Jesse.
It's a good time. It's going to be better. Excited to talk.
He helps a lot of people out when he comes on this show.
I think a lot of people really rely on you, though, for information.
Yeah, I mean, I guess that's true, but I mean, I'm not obviously solo team. We've got a few different folks in the team, including Bronson, in investor relations to help out with all that. So, and yourself and Kyle. And so, yeah, it's definitely a team effort to do everything. Yeah. I mean, we have a few hundred investors at this point, so it definitely requires a team. No one could do it alone.
But it's the group effort, right?
It is, absolutely is. It takes a team.
Yeah, I think one thing that's really interesting is your background is really interesting, just as a reminder for everyone. Jesse comes from the investment space. Maybe Jesse can just give us a real brief kind of 30-second background, just because you've done a lot in the investment space.
Yeah, I mean, it's funny. So I'm a little bit of a nerd. So even despite, with doing actual professional work within investments, I've just devoured as much as I can, and just personally in reading, and so I try to have kind of a wide breadth of knowledge, kind of within investments generally. But I mean, there's so much there, so many different directions you can go within investments. I'm saying that with quotes. That can mean a lot of different things. But yeah, I mean, my professional career started with Morgan Stanley. I was there for a few years. I had to get some securities licenses for trading. I mean, technically I was licensed as a financial advisor, but I primarily worked on a trading desk. And, I was there for a few years, left, and eventually, went into, the startup scene, into e-commerce, which was great, for a little while. Started my own company, my own software company, and did that for a while. But then kind of went back into investments. So I've kind of went back and forth between investor, operator, and started my own fund and within private credit. And then that's when I met Jason, is when I was launching that fund and kind of got a more broader exposure to real estate. Real estate is what I knew the least about as an asset class, kind of relative to all the other asset classes within alternatives. And he really opened my mind to what's possible there and what we're able to do for our investor partners. So it was beyond intriguing. Intriguing is an understatement. And I realized I could be a lot more successful and have a lot more fun within the real estate asset class than anything else. So,
and you've liked this area you've liked investing since you were a kid, ever since.
Oh yeah. You know what's really weird? I remember in junior high taking this test, and it was a career assessment test, and it was really comprehensive, probably too comprehensive for that age, kind of looking back. But after the whole test was complete, the final result of recommended field based on all the variables, your personality, your interests, all those things, was stockbroker. All right, cool.
Pinned it right on the head like that.
But then this is junior high, so I had already started trading stocks. Maybe there was some bias in the survey, and I was like, oh yeah, because of this. Maybe there was a bit of leading questions in there. I'm not sure.
Trading stock in junior high. That is awesome.
That's really cool.
I was just trying to trade chocolate milk at lunch, honestly.
I did that too.
To start somewhere with trading, right?
chocolate milk, regardless of the age.
Oh, man, that's so great. Well, there's one thing that when it comes to the investment space that really spans all of it, no matter what you're into, and it's just the topic of returns. What does return mean? Because return in real estate, return in venture, it's everywhere that you go. And so maybe that's a good place to start. Specifically, let's start on the real estate side, on what we do with Harris.
Okay.
On when we're talking returns, what does that mean to Harris Investment Group or to real estate, people that are interested in real estate?
Would it be helpful to define what we use as returns?
Yeah,
okay.
Let's do that.
Okay, so number one, there are dozens of ROI metrics out there.
Yes.
So there's lots of different ways you can grade or measure return on investment. What's important is identifying what is the correct ROI metric for a given asset class or a given asset. Mm-hmm. And so within real estate specifically, to go to your question, we have what's primarily used is a ROI metric called internal rate of return, or IRR. Mm-hmm. Another one is is multiple on invested capital, MOIC. And then another one that's folks are probably the most familiar with is cash on cash. That's used a lot. So let's see. Cash on cash is pretty intuitive. At the end of the day, how much cash are you making on an annual basis from your investment? If you put in 100 grand into a property and you made 10, then you have a 10% cash on cash return. So that's a net number, pretty easy to understand. Similarly, multiple on invested capital is fairly easy to understand too. Pretty intuitive. If you were to put in 100 grand into investment and that 100 grand turned into 200 grand on a gross basis, that is a 2x multiple or a 200% return. The third metric, IRR, is probably the most esoteric. And I mean, it is so much that, I mean, I'm a finance grad, but I never learned the actual formula because they don't teach you. They say, use Excel.
Excel?
It's not like high school where they say, you have a calculator, but you can't use it, so use your pencil. In college, they're saying, yeah, use Excel. That's what you're going to be doing when you're putting together financial models. So use Excel. Anyway, the formula is really complex, so they have you do Excel, use Excel for it. IRR is the total return over a period of time. So it factors in the time value of money. So if I were to say, Bronson, give me $1 million and I can double it in 1 year, or I could double it in 2 years. Which do you choose?
Yeah, I want 1 year.
You want 1 year. You want 1 year every single time. Absolutely. And why do you want it in 1 year?
Because I can do it again the second year.
Okay, sure. $1 today is worth more than $1 tomorrow, right? And so that is true. And so that principle is embedded in internal rate of return. So it factors that in, and what's interesting though, it's a non-linear return. And so if I double your money, from an IRR perspective, that is 100% IRR. If I need 2 years to do it, I believe that's a 41% IRR. Not 50%, 41. 3 years, 26%. 4 years, I think it's 19%. 5 years, 15%. Again, I'm rounding, right? But the point is that it doesn't scale in a equidistant and linear way. But it factors in time. And so why is that important? Well, in real estate generally includes cash flow. You're buying an asset that provides cash, right? And so how do you weight the cash flow you received in year one, that 10 grand when you put in 100K and you got 10 grand this year? And if you hold it for 10 years, what is that 10K worth today or in year one versus in year 8, 9, or 10? Well, it factors that in. So the short of it is, what's important to understand, at least from this, in this conversation, is it's wise when considering opportunities within real estate, whether it's your own investment opportunity or working with a firm, to consider apples to apples. Do your own analysis. If I do this deal, how much would the IRR look like? If I do that deal, what's the IRR look like? And then of course, I would consider the other variables too. I like to look at personally IRR and MOIC, the multiple invested capital, because IRR tells the story of the return in regards to time, whereas MOIC tells the story of the total return.
Yeah.
Put in this, I got that. And if I say 18% return, it's not exactly clear what the total return was.
Yeah.
But the MOIC answers that question.
Yeah, this is it.
But if I say, I'm going to double your money, you're like, in how many years? In 30 years, like, oh, well, that's not as interesting, right?
Yeah.
And so the IRR tells part of the story, MOIC tells the other half. Having them both together kind of gives you a more comprehensive view as to what the total return looks like for a given investment opportunity.
Yeah, no, that's so good and that's so important. I know for me, that was always initially tough to understand, but then I started to see exactly what you said, the story. You got to have both. You got to be able to understand both. So going now to two other things that affect return and just in anything, honestly, but let's go to the subject of absolute versus relative. And what that means, and
well, this is good. This is the details.
Yeah, this is the details. Something you should all listen up to, because I love listening to this type of stuff. It's really interesting. Yeah,
it's a super important concept for obviously investing with us. But forget about Harris Investment Group for a second. Just any of your investments. It's really important to understand what a good return is. So if you were to ask a novice investor, someone who's investing for the first time, what a good return in the stock market is, Like, and I'll just ask you, Bronson, what's a good return in the stock market?
Depends what I want, honestly, my needs, but I'm going to say 12%.
12%. Yeah. I mean, if you look back in different periods of time, that could be a common average, right? I think if you go back and you adjust for inflation, back as far as we can over the last 100 years, I think it's around 7%. But the question becomes, in what time frame, right? Time, like that should be the next question. It's
What's going on during that time too?
Yeah. What's a great return in real estate, MattyP? Oh, and by the way, it's 2007.
Oh man.
Oh, by the way, it's 2021. You guys see what I'm getting at?
It's very different.
It's all about the time in which you're investing. So the time adds the context that helps you understand what a good return actually is. So why is this important? Well, markets are cyclical. That means they go up and they go down. There's ebbs and flows, peaks and valleys. And no investment is insulated from that market cyclicality. There's relationships between all different asset classes and the different economic levers that are out there. But by and large, there are ebbs and flows, right? Yeah. And so it's important to understand that, because the better an investor can have a long-term orientation to their investments and their working capital, then the easier investing is, and the more fun it is, and the less stressful it is. There's a lot of research that's been done on investor psychology. And in fact, a lot of people weigh this as a benefit to private investing, because they say, hey, good news, your money is tied up. It's locked up in a property, for example, in real estate. So despite your natural instincts to knee-jerk reaction, they're raising interest rates, pull all your money out, right? Which is like the common retail investor reaction.
Yep.
You can't do it. So it acts kind of like it protects you simply because it's a liquid, right? And so investor psychology and understanding and being cognizant of one's own psychology and how you think about loss aversion and how you weigh gains and losses is really important. Okay, so let me go back to relative versus absolute returns, because MattyP, you said that I explained it really clearly, so I want to make sure that I explain it clearly.
No pressure.
And so I will. So here's an example. We sold our firm. We had an asset sell in Q4 of 2023, and we sold it for 16% IRR. Okay, that was the return, 16% IRR. We targeted 20%. Okay.
Oh no, that's less, Jesse.
That's less.
Oh no.
And so I remember I was talking to a younger investor. He hadn't invested with us, so I guess technically he's a prospect. But I was explaining to him about a recent deal, because he had asked about a recent deal, and his reaction was immediately negative. It's like, oh, that's less. Too bad, kind of a thing. And I went on to explain, well, let me tell you a little bit more. I explained that 16% was derived in a time frame from, Q2 of 2021 and held and sold in Q4 of 2023. Now, any investor that's familiar with the markets and interest rates and real estate in that time frame would say, whoa, you eked out any return? That's phenomenal. Like look at public market equivalent, like pick a REIT index, and you would see probably anywhere from a 7 to 15% loss during that time frame. Wow. And so even having a gain of any sort is a win, yet alone a 16% IRR, right? But that's the context of the investment duration. And that's why understanding like the investment vintage or the year that you invest is so critical, because investing in real estate in 2021 versus 2007, 2008, even worse.
Oh yeah.
Right? Those are investing right now, right? Like those are all different vintages. And this is not just to real estate. This applies to all asset classes, right? 2018 was a horrible year, kind of across the board for all asset classes, like outside of treasuries, right? You're in public market equities, you're in fixed income, you're in real estate, commodities, everything was like terrible. And then 2019, like everything was really rosy, mostly across the board, right? And then, for equities specifically, like 2019 was great, 2020 was great, 2021 was phenomenal. And then 2022 happened, right? And then it went back down. And so you have these ebbs and flows, and that is just the part of the market cycle. So there's this really common adage in investing that is time in the market is better than timing the market. And the reason why is because no one has a crystal ball. And anyone that purports to have one, no one says that, but people are pretty dovish in pretending like they can predict or they have an understanding of what's to come in the future, right? A lot of pundits you'll hear online that will talk about this is what they expect. Mm-hmm. And the reality is no one knows, right? So I'm channeling my inner Howard Marks here. If you guys are familiar with Howard Marks, he's the guy who started Oaktree. Mm-hmm. And I love, his investment memos and how he talks about this because it's so true. Nobody knows. The economy is way too complex. Financial markets are way too complex to even try to predict what's going to happen next. Way too many variables, way too many levers. And so if you don't know what's going to happen, what do you do? Yeah. Right? Yeah. Like what's that actuary adage? The past is not a good predictor of the future, but the past is all we have kind of a thing.
That's my type of language. I'm a stats major. So you're speaking my language right there.
So it's like, anyway, if you can't predict what's going to happen, but we know if you look at long-term trends across different asset classes, things are generally up and to the right, especially with real estate, especially with, public equities. Mm-hmm. So that's why it's helpful to have this understanding between absolute and relative returns, because if you invest today and you're expecting a 20% return because that's our average, and then when you don't hit it, then you're going to be really disappointed and you're going to get short-sighted and then you're going to make poor decisions. But if you have a long-term orientation, you understand market cycles, you understand, hey, relative to the market, that's a really great return. Or hey, maybe the market, REITs do 20% and we only deliver 10. That's a bad return, right? Take the other side of it, right? Say things are like super bullish and everything goes really, up and to the right and we don't deliver as high, right? We don't deliver any additional alpha. That's terrible, right? So it works in both directions. So understanding relative returns, understanding the importance of investment duration and when you have an investment and when that hold period is critical to having the correct framing beyond to answer the question, what is a good return? Was this a good return? How did I do with this investment?
So it sounds like you have to factor in current market rates into whatever investment you have to really understand if it was a good or a bad investment.
Yeah.
It's all relative. Yeah. The relative aspect of it.
Yeah, absolutely. Markets behave differently when interest rates are different levels. When interest rates are at zero, like they were for such a long time, everything in the market behaves differently. And when interest rates are higher, then
money's expensive.
Things are, money's expensive and everything gets weighted differently. If you can eke out, the risk-free rate, I don't know what it is today. If you were to think of it as a three-month treasury, that's, call it 4.5%. So you could take a risk-free approach, technically not take on any risk and earn 4.5%, right? And so that risk-free asset impacts how we think about risk assets or assets that you take on risk. They're not risk-free, which is basically just limited to government treasuries, right? Everything else are risk assets, and that should impact how we underwrite and value other potential opportunities, like you said. And maybe that's beyond kind of a 101 conversation, but super important to have a better picture of the overall.
Yeah, like you can't
framing.
Just look at your investment solely and make any conclusions based off of that. It has to involve the rest of the market.
Exactly. Yeah. So, it's unfortunate sometimes because, we can do our best as an active manager, just using Harris West Group as an example. We can acquire an asset, we can run our business plan, we can increase its value, but we do not operate within a vacuum where nothing else impacts us, and there aren't any other, outside variables that can impact the value of our asset. Because that's not true, and there isn't a case of which that is true. We are impacted by all sorts of things macro. And so it's a reality that you have to understand. And so you go in with a long-term view. You should be investing all the time, every single year. And that way, all those large ups and downs, ebbs and flows, you zoom out and it becomes like a real steady, smooth line, right? You zoom in, you look at a stock chart of it, pick a stock. Yeah. You look at the daily chart, just up and down, up and down. You zoom out to a week and it's a little bit less, a month, even less, right? Unless it's a crazy volatile stock. You go out a couple of years and you just see it kind of smooth out. It's the same thing when it comes to investing, and just having that long-term orientation is paramount.
Wow, that's so good. Jeez, maybe I think, my mind, just listening to you speak, and maybe we can close out with this, is I want to know your top 5 books, Jesse Yeats, for investing, because I think you could give us, or maybe your top 3, like that you really, really enjoy and that you would suggest, because I think a lot of the people listening would love to go and read those. And I know here at Harris Investment Group, right? I mean, everyone has been self-educated through reading a lot of different books on investing. I know Jason's really big on self-educating on, investing, real estate, taxes, all of the above. Matt Denning, you, I mean, everyone is. So I've never asked you this, but is there a top 3 on the Jesse Yeats?
So let's see. Specific to investing, my list will be different from Jason's for sure.
Yes, that's a good thing. I knew that.
I've read a number of real estate books, but none of them probably make my top. Or are a top favorite. Ooh, I already mentioned Howard Marks. The Most Important Thing, that's a great book. Also, Mastering the Market Cycle, that's a great one.
Mastering Market Cycle.
Oh, Nassim Nicholas Taleb, famous statistician and professor. Yeah, he's written a ton of books. The Black Swan's a pretty popular one that came out, post the Great Financial Crisis. Skin in the Game.
That's a good one.
Fooled by Randomness. That's a really great one.
Never read that one.
Another interesting one is a book called Safe Haven by Mark Spitznagel, who actually is a partner with Taleb. Really interesting. Talks about barbell strategy and kind of goes into the math behind it. That's a fascinating read.
I love the barbell strategy.
There are so many great ones. Big Short was really entertaining. Love that book. I mean, anyone that wants to understand the Great Financial Crisis, that book is a must and is a fun read. Jeez. Anyway,
those are all great.
Yeah.
Oh yeah, those are.
There are so many good ones.
Oh, a wealth of knowledge, Jesse Yeats.
Oh geez.
Seriously, thank you.
Always the compliments. You too. Always so friendly.
And we'll get you on again. But I'm serious. I think you're gonna have a lot of questions.
Yeah, I hope so. If there are questions, always happy to talk more and talk through things.
Yeah, reach out, contact at harrisinvestmentgroup.com. Just put in the heading podcast or questions, doesn't matter, and we'll make sure we get those questions answered. And if you have specific ones for Jesse, just put Jesse's name in there, and we'll ask Jesse next time, because you're coming back, Jesse.
Deal. I'm in. I'm close by.
Yes, sir.
Okay, thanks, guys.
Special shout out to our producer of this podcast, Litiana Akinaka. Thank you for all your work on the front and back end of this. It's much appreciated. And I hope you find your dad. Thanks, Jesse, Bronson. Until next time. We talked about Jesse's boots, but shoes are pretty cool too.
You know what? I wish I could say that I bought these, but I didn't. My wife did.
Shout out to Hillary.
Shout out to Hillary. Right. Shoe game's always strong.
That's right.
Yeah.